What if I told you that one of the biggest wealth-building myths in America is that you need a lot of money to start investing? The truth is, you don't. In fact, some of the most powerful investment accounts in the country can be opened with as little as $1. Today, we're going to break down exactly how you can start investing with just $100, step by step, no jargon, no fluff. This is educational content designed to give you the knowledge to make informed decisions. Let's get into it. Here's the thing most people miss. The most important variable in investing isn't how much money you start with. It's how early you start. This comes down to compound interest. That's when your money earns returns, and then those returns earn returns on top of returns. It snowballs over time. Historical data shows that $100 invested at age 25, left untouched in a diversified portfolio, tends to grow dramatically more than $100 invested at age 40, even if the 40-year-old contributes more money later. The math strongly favors getting started now, even with a small amount. Before you invest a single dollar, you need to pick the right container, and by that I mean the right account type. If your employer offers a 401k with a matching contribution, that employer match can be one of the most valuable benefits available to you. Many financial experts recommend contributing at least enough to capture the full match before investing elsewhere. Next, consider a Roth IRA. You contribute after-tax dollars, and your money may grow tax-free, which over decades can be a tremendous advantage. If you've maxed those out or need more flexibility, a standard taxable brokerage account works too. The account type matters as much as what's inside it. Now let's talk about what to actually put your $100 into. For most beginners, index funds and ETFs, exchange-traded funds, are widely regarded as the smart starting point. An index fund simply tracks a benchmark like the S&P 500, which represents the 500 largest publicly traded companies in America. Instead of trying to pick winners, you own a tiny slice of all of them. Historically, the S&P 500 has returned roughly 10% annually on average over the long term, though past performance does not guarantee future results. Look for funds with low expense ratios. That's the annual fee. Ideally under 0.20%. Every fraction of a percent you save in fees stays in your pocket. Let's pause on this number for a second. Historically, the S&P 500 has delivered approximately 10% average annual returns over the long run, before adjusting for inflation. After inflation, that figure has been closer to 7%. Now markets go up and they go down. There will be crashes, corrections, and scary headlines. But the data is clear. Investors who stayed the course through downturns, including 2008 and 2020, generally saw their portfolios recover and grow. This is why diversified, long-term investing in broad market index funds has been a foundational strategy for many American investors. This chart shows something remarkable. If you invest just $100 a month starting at age 25, that's roughly the cost of a few streaming subscriptions and some takeout, and you achieve a 7% average annual return, by age 65 you could potentially have over $260,000. The total amount you actually put in, around $48,000. The rest, more than $210,000, comes from compound growth over time. Now flip that. Start at age 35 and that number drops significantly. The math here isn't magic, it's time. And it's one of the most compelling arguments for starting today, even with a small amount. Once you know what to invest in, the next question is how to invest. And one of the most time-tested strategies for everyday investors is called dollar cost averaging. Here's how it works. Instead of trying to time the market, which even professional fund managers consistently struggle to do, you invest a fixed dollar amount on a regular schedule. Say $25 a week or $100 a month, regardless of whether the market is up or down. When prices are lower, your fixed contribution buys more shares. When prices are higher, it buys fewer. Over time, this tends to smooth out your average cost per share. It also removes the emotional decision-making that causes many investors to buy high and sell low. Here's a look at the S&P 500's performance over recent decades. What you'll notice is this. Yes, there are sharp drops. The financial crisis of 2008, the COVID crash in early 2020. Those are real and they are frightening when you're living through them. But zoom out. and the long-term trend has historically been upward. Investors who panicked and sold during those downturns often locked in losses and missed the recovery. Investors who stayed invested, or kept dollar cost averaging through the dips, historically fared much better. This chart is a visual reminder of why patience and consistency tend to be rewarded over time. Let's get practical. Where do you actually open an investment account? Today, several major brokerage platforms, including Fidelity, Charles Schwab, and Vanguard, offer accounts with no minimum balance requirements and zero commission trades on most ETFs and index funds. If you want a more hands-off approach, robo-advisors like Betterment or Wealthfront will automatically build and rebalance a diversified portfolio for you based on your goals and risk tolerance, often for a small annual fee around 0.25%. The most important thing is to avoid platforms with high fees, limited fund choices, or confusing interfaces that might discourage you from staying consistent. You can literally open an account in under 15 minutes today. Now let's talk about what not to do, because the mistakes beginners make can be just as costly as not investing at all. First, do not try to time the market. Research consistently shows that even professional fund managers fail to outperform low-cost index funds over the long term. Second, avoid actively managed mutual funds with high expense ratios. Fees of 1% or more can quietly consume a large portion of your long-term returns. Third, resist the pull of speculative investments, meme stocks, highly volatile assets, or anything promising quick, extraordinary gains. All investments carry risk, and speculative plays can result in significant losses. Finally, resist the urge to check your portfolio every day. Volatility is normal. Stay the course. I want to show you something that doesn't get enough attention: the real cost of investment fees over time. This chart compares two identical portfolios. Both start with $5,000 and add $100 a month for 30 years, both earning 7% average annual returns. The only difference is the expense ratio. The low-cost fund at 0.05%, typical of many index funds, grows to approximately $117,000. The high-cost fund at 1.5%, common in actively managed mutual funds, grows to only about $89,000. That's a difference of roughly $28,000, lost entirely to fees. The investment itself performed the same. This is why expense ratios matter enormously over a long time horizon. Here's a number worth sitting with. According to Gallup's 2023 data, approximately 58% of Americans report owning stocks in some form, through a 401k, IRA, or brokerage account. That means roughly 42% of Americans have no market exposure at all. No compounding, no long-term growth. Many of those people aren't avoiding the market because they don't want to invest. They simply don't know where to start, or they believe they don't have enough money to begin. That's exactly why financial education matters. The knowledge gap is real, and closing it is the first step toward building wealth. You watching this video right now is already a meaningful step forward. Let's bring it all together. Starting with $100 is not just possible. It's a genuinely smart way to build the habit and the knowledge that compound over a lifetime. Here's your action plan. Step 1. Open a Roth IRA or a taxable brokerage account today. Platforms like Fidelity or Schwab make this straightforward with no minimums. Step 2. Choose a low-cost index fund that tracks the S&P 500 or the total stock market. Step 3. Set up automatic monthly contributions. Even $25 or $50 a month builds meaningful momentum. And Step 4. Stay consistent. Don't panic during downturns. Don't chase hot stocks. Time in the market, backed by historical data, has been one of the most powerful wealth-building tools available to everyday Americans. This is for educational purposes only. Please consult a licensed financial advisor for personalized guidance. Everything you've seen in this video is for educational purposes only and does not constitute financial advice. All investments carry risk, including the possible loss of principal. Past performance does not guarantee future results. Please